Deckers has been one of the best performing stocks over the past decade, quietly outperforming giants like Apple, Tesla and even the S&P 500. But now it's down nearly 40% from its all-time high. Is this just a temporary dip? Or is the market signaling something much worse? With consumer spending shifting and competition heating up, should investors be buying the dip or staying far away? Let's break it down. Welcome to the channel, friends. In today's video we're going to be talking about Deckers. Many of you probably have never heard of Deckers, and to be honest, neither have I. But when I first came across this company, I looked further into it. They own a few companies. They own a company called Uggs, which most people know about. They own a company called Hoka, Teva, and also Anhu. These companies are mainly footwear companies, so you've got all sorts of footwear. You've got sandals, you've got shoes, you've got running shoes, so there's many different footwear in here. Going over some of the numbers for Deckers, it has a market cap of $21 billion, so it's on the smaller side when it comes to the company size. It has a PE ratio of 22, which on its own doesn't mean anything. We gotta compare against where it has been. Very minimal debt, as we can see over here. In terms of the growth and profitability, we could see that the revenues have been increasing year on year, the net income has been increasing year on year, and the net margin has also been increasing year on year. So this company is heading in the right directions and it has a lot of profitability in it. It has net margins of about 17%. The year before that was 14%, so it's a very profitable company in its sector. Hoka and Uggs, they make up most of the revenue when it comes to footwear. This is just something to be aware of. And when it comes to their earnings, if you look at the last 4 quarters, they've met and they've exceeded their targets for both their revenues and the earnings. And if I switch it to annual, it's the same for the last 4 years as well. So this company has a really good track record of meeting their targets. They have an uptrend in their free cash flow as well, and they have enough assets to cover their liabilities. So far on the surface of it, all of this looks really good. Now let's go deeper into some of the numbers. As a quick summary, we could see the EPS, the earnings per share, has been increasing every single year. The sales have been increasing every single year, and the shares outstanding, they've been buying back their shares. Absolutely amazing to see so far. PE ratio 22, PEG ratio 1.39, so it's not less than 1, so it's not very undervalued, so it's a fair valuation in terms of the PEG. The price to sales ratio 4.3, price to book slightly on the higher side, and they've got low debt. Their current ratio is good. All of their numbers do look on the good side. So the earnings per share 26% a year every year for the last 5 years. The sales every single year 16% over the last 5 years. Gross margins of 56%, which is really good in this sector in retail, and a return on assets of 25%. So very good so far. Let's compare where some of these numbers have been in the past. Looking at finance charts, when we look at their PE ratio, their PE ratio is currently 12% lower than where it has been over the last 5 years. This suggests that it is cheaper than where it has been. And when we look at the price to sales ratio, this is only 2% higher than where it has been over the last 5 years, around the same price as it has been just using this metric alone over the last 5 years. But if we look at compared to the last year alone, it's 23% cheaper than where it has been. This shows how much it has dropped in the last year. When we scroll down to the price to book ratio, although the price to book ratio is 8, which is on the higher side, it's still 8% cheaper than where it has been, and the price to free cash flow ratio is 26% better than where it has been over the last 5 years. So this is really good to see. Diving deeper into their revenue, you've got a breakdown of their different brands, and you could see how much money it's making every single year. Since 2020, pretty much all sectors have been rising. So the direct to customer sector has been rising, the Hoka brand has been rising, and the Uggs brand has been fairly flat, but it's still slightly rising if you do look at some of these numbers. And the other smaller brands, they've been rising as well. But majority of the revenue comes from just these 3 sectors, the top 3 that we see over here. Going deeper into some of the numbers, the operating margin has been increasing every single year, which is a good sign. The free cash flow per share in blue is also increasing every single year. This trend is up, and also the EBITDA margin is increasing every single year. So this company is making more money, is keeping more cash, and is getting more efficient in terms of how it's using the cash, which is really good to see. When we look at some of the other financials, such as the price to operating cash flow, Deckers is on the lower side of things. The lowest it's been in the last 5 years is 14, and currently we're trading at a price to operating cash flow of 19. The average is about 32, so it's much cheaper compared to where it has been. If I extend this out to a fuller time frame, the cheapest it has been was maybe in 2017, where the minimum was 6 over here. However, when we do look at metrics such as the forward PE, we are currently trading higher than average. The average is 17 and we're currently trading at a forward PE of 21. But just a couple of months ago, this forward PE was 35. So we got to put things into perspective over here, but it's just something to be aware of. Now let's look at the chart of Deckers. So since Deckers went public in 1993, initially it went down, but since then the trend has been up. Since 2020, we're talking about the price going up about almost 1000%, outperforming some of the tech stocks out there such as Tesla and Google. The next question is this company a bleeder or not? Meaning, how has the performance of this company been against the S&P 500? And let's do that. We could see overall the trend is up, meaning this company has outperformed the S&P 500 in the longer run. And if we just look at from 2020, which is about here, this outperformed the S&P 500 by over 200%, which is really good to see. If I add some moving averages to the chart of Deckers, I've added the 200-week moving average and the 50-week moving average. We could see Deckers is currently trading above the 200-week moving average, but it's lower than the 50-week moving average. More recently in 2021 and 2022, it did go below the 50-week moving average. However, it stayed above the 200-week moving average. At the 200-week moving average, then that would have been a really good price to buy at. And since then, it's been going up. And right now, it's broken the 50-week moving average, and potentially it might test the 200-week moving average. It's hard to predict these things. However, when looking at the chart, I could see that there's some support in this area here. So we've touched this trend line, which I'm about to draw. So we've touched this trend line 1, 2, 3 times. And if we hit again at around $134, then that's another hit of the trend line. So this line might act as a support, but we don't know yet. Let's talk about some of the risk with Deckers. We've seen with Deckers that the financials look really good. They make a lot of profit. Their revenues have been increasing every single year. They've been buying back their shares. They're doing all of the right things. However, there are a few risks that was mentioned in the latest earning calls, which I thought I'd mention. The first risk is foreign exchange. Recently, the dollar has been surging. It's gone to all-time highs. And because of that, the cost to import from other countries is much more expensive. So their global operations from this will take a hit when it comes to their profit margins. That's one thing to be aware of. The second thing is consumer confidence. When consumer confidence is high, they are happy to spend more money because their confidence in the general economy is high. And we could see the consumer satisfaction was at all-time highs recently and has started coming back down since then. And this has been reflected in the price of Deckers because recently it was at all-time highs. It has come down 40% since then. If customers are not satisfied with the general economy, then they're not likely to spend as much money. And the products that Deckers sell, such as luxury shoes, Uggs and things like that, they are expensive. There are cheaper alternatives available. If people are sticking with things like Deckers, that means their confidence in the general economy is good. The third thing, there's talks about tariffs going on from Donald Trump, and we don't know how that's going to end. We don't know if he's actually going to go ahead and how these are going to affect businesses. But this is just one thing to be aware of because things will be more expensive to import into the US, and this will hurt the supply chain and other things as well. So this is one thing to be aware of. The other major risk is the risk from competitors. Deckers has a narrow economic moat. This means that if someone wants to start a business and copy exactly what Deckers are doing, it is possible because Deckers, they are very profitable. That's what their moat is. However, in terms of the products that they are creating, it is possible that it can be copied. And unfortunately, that's how things are in the world of retail. Deck does have a lot of competition. There are other companies such as Nike, Lululemon, OnCloud, Skechers and Crocs. These all pose competition to Deck. And there are other companies as well which I've not included. If we compare these companies that are bigger than Deck on this list is Nike, which most people have heard of, and Lululemon. There are other companies on here which are slightly smaller than Deck. So we've got OnCloud running, we've got Skechers, and we've got Crocs. If we compare some metrics from them, if we look at a forward PE ratio, Deck has one of the lowest from all of them. Only Skechers and Crocs has lower forward PE ratios, but they are much smaller companies as well. When we look at price to operating cash flow of 26, whereas the other companies is very varied. So Nike has a price to operating cash flow of 19 and Crocs has one of 6, and OnCloud running has 44.6. So it's very varied. So on its own, it's very hard to compare. When we look at forward price to sales, Skechers wins over here and Deckers trades at a premium compared to some of the other companies as well, such as Crocs and Nike. However, one thing to look at is the revenue over the last 5 years. The CAGR for Deckers is 18%. Only Lululemon and Crocs has higher than this. And when we look at the CAGR for the earnings per share over the last 5 years, Deckers is 30% and only Crocs has higher than this. And even when we look at the operating operating margin, Deckers has the 23.5% operating margins, and only Lululemon has something similar, and Crocs. So from this list, Lululemon and Crocs look really good. And from the two, personally, my favorite is Deckers and Lululemon. Crocs is a good company. However, one thing I don't like about Crocs is its forward growth. In 2025, they're expected to grow their revenues by 2%. In 2026, 3%. 2027, 1%. So as good as Crocs has been in the past, there's not much growth left in terms of the future unless they change something dramatically. Lululemon, however, they do look really good. They have consistently grown, they've met their targets, and this year they're poised to grow 7%, and next year they're poised to grow 8%. So let's look at Deckers' growth then. Deckers' growth has been even more impressive compared to the previous two companies. In 2025, this year, they're expected to grow 11%. Next year, they're expecting to grow 10% in terms of their revenue. So this is more than Lululemon, and this is more than Crocs. And this is why Deckers looks really good to me, and only second to that would probably be Lululemon. Now let's see what the forecast is for Deckers going forward. There's 19 analysts that have looked at Deckers and they've labeled it as a buy. The low end of the targets is $185, which is 32% higher than where we are right now. The high target is $284, which is double the price where it is right now. And the average target is about $226, which is about 60% higher than where we are right now. So based on this, most of the analysts think that the price right now is very undervalued. And if we look at the Morningstar report, they give Deckers a fair value of $120, and currently we're trading at $139. So Morningstar is the only analyst where they have put a lower price target for Deckers, whereas the average from the other analysts are about $226. So it's a very big variation. Morningstar has labeled Deckers as a narrow economic moat because it's a retail company and there is plenty of competition. My opinion on Deckers, it's a very good company. However, it's still trading at a high valuation, but when we couple that with the growth that it's experiencing, then it's really good. And currently, with 37% off the highs, and this has happened over the last month, we're trading below the 50-week moving average. And if we zoom out, there have been a few times where Deckers has been trading below the 50-week moving average. 1, 2, 3, 4, 5, 6, 7 and 8. So there's been 8 times in its history where it has been trading below its 50-week moving average, but it's always ended up bouncing back up eventually. When it has gone below the 50-week moving average, there has been times where pretty much most times it has hit the 200-week moving average, and we could see that over here. So if Deckers was to hit the 200-week moving average, then we're talking about a share price of about $100. And if Deckers was to go to $100, then I'd be very confident in buying this company. I have been curious to see how far Deckers has fallen in the past before this. This strip at the bottom shows a percentage decrease from its all-time highs, and if I'm to zoom out, we could see the overall pattern something like this. Now if I draw some lines, I could see that about this level, a 44% decline, it has been there 1, 2, 3, it has been there a few times. The other levels I see is maybe about the 62% level around here, and the other level is the 76% level, which is around here. So we got 1, 2, and then we got lower here, but this I'm going to ignore this bit because it was new at the time, the company, and they were going through the Great Depression. And just out of curiosity, I wanted to mark and see where the prices lie. And if I start with the minus 45%, then we're talking about a price of $122. And if I was to mark minus 62%, we're talking about a price of $84. And if I mark down a price of about 76%, then we're talking about a price of about $52. This shows that potentially, if history is to follow, there may be a lot of downside for Deckers. Me personally, I don't think 52% will happen, not anytime soon anyway, but it's just interesting to be aware of that this is a possibility. 62% down, so about 84%, that's very possible, and if it does come to this, then it is very tempting to buy. What my plan is personally is, whilst the price is below this 50-week moving average, I am dollar cost averaging £50 every week into Deckers, and I'm going to continue doing that until it gets to 200-week moving average, which is where I'll start a bigger position, and I'll continue DCAing, and if it does ever go down to those drawdown levels that I've mentioned, then those drawdown levels I've mentioned of about $84 or $52, then I'm going to add significantly more then. However, I'm not going all out in Deckers. It is a narrow economic moat company, and you gotta be careful with these sort of companies because there is competition does eat it, and there might be another company that comes around, the new trending stock, when it comes to retail. These things we just got to be aware of and invest accordingly if you are going to. None of what I've shared in this video is financial advice. If you enjoyed this video, please like and subscribe, and please share with others. Really appreciate it. Thank you.